In this video, I want to discuss two of the most important day trading indicators that you have to be aware of in order to understand how the market actually works. And it doesn't matter what strategy you use, what market you trade in, penny stocks, options, futures, Forex, crypto. The concepts that I'm going to explain in this video are relatable to any market, and it's something that every trader has to understand as a core foundation to their trading strategy. If you learn anything by the end of this video, all I ask is if you could just drop a like on this video. It will help spread the message out to other traders. And if you have any questions, I'll post a link to my Instagram in the description below. I answer pretty much every single question I get on a daily basis, and it's a good resource that I recommend following as I post daily trading recaps and things that you're just not going to find anywhere else on the internet. Again, the link for this will be in the description below. But now let's get right into this video. So the first thing we have to understand is different order types in the market. The first order that we talk about is a limit order, and this is what I call a passive order. I'm sure a lot of you watching this have seen what a limit order is versus a market order. And a limit order essentially is making you buy or sell a specific stock, Forex, future contract, crypto, at whatever specified price that you're looking to buy at or better. Let's say a stock is trading at $105 and you want to buy at $100. Well, for you to buy at 100, all you have to do is put a limit order at 100, and that is going to be filled at 100 or better in your favor. Now, when we put a limit order in the market, we are buying on the bid and we are selling on the ask. If we're looking to purchase something, we are putting a limit order on the bid. And if we're looking to sell something or get rid of a position, we are looking to sell it on the ask. This is the most passive type of order because you are letting the market come to you. And this can be seen from a level 2 or a depth of market, which are very, very important tools to understand. The second order type is an aggressive order. This is saying, I want to get in right now. I don't care what price I want to get in at. The market is breaking out and I want to buy it. I want to scalp it and I want to capitalize on a fast day trading type of move. This is a market order because you are so aggressive. You are hitting the market aggressively. And this also can be seen from a time and sales because this completes a transaction. We have a market order which hits a limit order. And when those two come together, we have a completed transaction, and a completed transaction will be seen from a time and sales. Now, going back to passive orders, these can only be seen from a level 2 or a depth of market. This is the order book, and this is the central, most important aspect to any market because this organizes the market via its order book or level 2. This tells us what price is bidding and what price is offering and at how much. And this structures the market in a way that we can see buyers and seller limit orders on the book at whatever price those buyers or those sellers are looking to buy or sell at. So in this screenshot down here, what you're going to see is on the left side of this, where I'm hovering my cursor, is a bid column with all prices that have bid. Now that is the price that someone has an order or multiple people have orders at that price to buy the S&P 500 future contracts. For example, at 4414.25, which is called the inside bid because it's the current closest bid to price, someone or multiple people are bidding to buy 68 contracts or lots in this example at 4414.25. 97 people are looking to bid or buy. Again, this is the order book, which can be seen on the level 2, which are all passive orders, aka limit orders. Someone's looking to buy 97 contracts at 441400. Now to the right side, we are going to see the ask column. These are all passive sellers in the market. So the left are buyers, the right are sellers. These are passive sellers looking to sell at 4414.50, 97 contracts. Directly below that, we got 4414.75, and someone's looking to sell 137 contracts, whether it's one person or 137 other people. That's not important. What's important is the size at that specific price and the intention to buy or sell via a limit order. Now, we could also see a level 2 on a vertical basis, and this is a vertical order book. In fact, this is the most common way to view an order book because it's displaying the level 2 on a vertical basis. The same thing that I explained, the left side are the passive buyers, the right side are the passive sellers. We can obviously see the price and the size on the ask and the size on the bid, and this is what makes up the market because it's the order book. So to validate this even further, what we have here is a vertical level 2 or the order book, which is also called the depth of market, where I'm hovering my cursor over. And directly below that in the blue columns is a horizontal level 2, which I'm sure a lot of you are familiar with. The same numbers are going to be the same no matter if we're looking at a depth of market or just a normal level 2, because as you could tell at 4.541.5, there's 82 contracts someone's looking to buy at that price. Now looking at the depth of market at 45.41.5, you could see that 82 number. Now directly to the right of that, someone's looking to sell passively 18 contracts at 4541.75. And looking at the depth of the market, you can now see at that price, there's exactly 18 contracts. So you're going to see the same information on either of the order books. It depends on what you want to look at. But to validate this claim even further, what I'm going to do is put a limit order on the market of 5 contracts. So a lot of you probably you buy and sell with a limit order because you are specifying what price you want to get in at. So in this example, I'm going to look to purchase 5 contracts via a limit order at 4540. I'm going to confirm and send it, and you're going to see my order now on the order book. Now this is a simulated environment. This is not a real trading environment. Now you could see it on the order book at 4540 via the depth of market or the level 2. And if this was a real order, there was originally 170 contracts looking to buy at 4540. However, I added 5 contracts to the order book. So this number, if it was a real order, would go from 170 to 175, indicating that I just added 5 contracts looking to passively buy at 4540. And we could also see that down here on the level 2. If this was a real order, you would see it as 4540 for 175 contracts because I just added liquidity of 5 contracts at that price. If I want to move my limit order up and I want to get in a little closer, all I have to do is now put it at 4541, and this 150 contracts looking to buy it there would normally go to 155 because I just added 5 contracts. Now those are passive limit orders. Now we have to talk about aggressive orders, which are market orders, which show completed transactions. If I just put 5 contracts at 4540, for my 5 contracts to get filled, a market order has to sell to me because I'm looking to buy. This can be seen on a time and sales because this shows completed transactions. So now I pulled up a time and sales on the right. I'm going to make this a little bit bigger. And again, if this was a real trading environment, you would have the time, which is a very important aspect to a time and sales, obviously. And it would say the specific time to the exact second. In this example, you're only seeing a date because I'm going back in time to August 2nd. But you would see on August 2nd at 10 o'clock Eastern, and you'd also see the price of which the completed transaction was done on. Remember, time and sales shows completed transactions in the market. When you see volume going up, essentially, if you were to add all the volume or all the transactions you see on the time and sales, that would equate to the volume that you're seeing. So if you're watching a candlestick chart and you see on a 5-minute bar, there's a volume of, let's just say 100. Well, if we were to add up all the tickets or all the transactions on the time and sales for that 5-minute period, you would equate to 100 contracts or 100 volume done at that specific time. Remember, time and sales. We're also going to see the sales, which is the size of those orders. So pulling up Tesla now to help you visualize this better. And again, you're going to see the level 2 down here. But also you're going to see the time and sales. We could see the size of the orders which got filled at what specific price. So at 255.09, the first ticket you see up here, someone either bought or sold 100 shares of Tesla at that specific price. Now, some time and sales differentiate between buy and sell. This is an example on ThinkorSwim, and ThinkorSwim does not sort data on a time and sales between bid versus ask. So normally, depending on your platform, green means buy and red means sell. On ThinkorSwim, I know a lot of you do use ThinkorSwim, all green means is the ticket came in higher than the previous, and all red means is the ticket came in lower or the same compared to the previous ticket. So at 255.09, there was a completed transaction of 100 volume. At 255.12, there was a completed transaction of 1. And we could go down the list. At 255.11, there was a completed transaction of about 3,998. Right? So we can add up all this volume. It would equate to what we're seeing on a candlestick chart, but the time and sales shows us completed transactions. I could also filter my time and sales. If I want to make it greater than 5 contracts or greater than 100 contracts, I can filter it to show large size, filter it to show small size. But the most important concept here, now that we understand the difference between a level 2 and time and sales, is a time and sales shows completed transactions, and a level 2 shows order book levels, prices that buyers or sellers are looking to get in at, which have not been completed yet. The only way they can be completed is if that price triggers. So I have that order sitting there at 45.40. The only way I can buy at 45.40 if I am on the bid is if the market comes down to 45.40 and someone sells to me. Remember, there's a buyer and the seller for every transaction. When they come together, that's when we get a completed transaction via the time and sales. So for my contracts to get filled at 45.40 and for me to get in long or buy these contracts, someone has to sell to me at 45.40 and we would see that completed transaction on the time and sales. Now, this is very important for you to understand because this is where it can go over a lot of people's heads. There are a few type of market participants and it depends on what side of the market are we on. Are we passive or are we aggressive? So for a transaction to be completed, and the only way you will see it on the time and sales is if a passive buyer, aka someone that has a limit order on the order book, is looking to buy on the bid. For him to buy and his transaction to get completed, someone has to aggressively sell via a market order on the bid. So a seller hits the bid to a buyer looking to buy on the bid. That is when you get a completed transaction when they come together. There is a buyer to every transaction and there is a seller to every transaction. Now, flip it on the other side now. We have a passive seller who has a limit order looking to sell on the ask. I want to sell when it comes up to $100, but it's only trading at 90 right now. I'm waiting, I'm passive, I am not so aggressive. Well, the only way for me to get filled at $100 on the ask is if an aggressive buyer comes into the market when we come close to 100. And that aggressive buyer hits the market via a market order, which hits the current ask when it gets close to 100. So the only way our passive order could get filled looking to sell on the ask is if an aggressive buyer comes into the market and buys our passive order. The common theme to this is you will always have a passive order and a market order. You can never have a market order hitting a market order. You can never have a limit order hitting a market order. It's always a market order hitting the limit order. To understand this again, just to recap it over and over, a passive or limit order, if you're looking to buy, you're going to buy on the bid. If you're looking to sell passively, you're looking to sell on the ask. If you are aggressive, you are buying by hitting the ask. And if you are aggressive, you are selling to hit the bid. A seller which hits the bid will get sold to by someone looking to buy on the bid. A buyer looking to buy aggressively on the ask is going to buy from someone looking to sell on the ask. You always have a buyer and a seller, and you always have a market and a limit order. You always have an aggressive versus a passive order. There will never be more buyers than sellers, and there will never be more sellers than buyers. I always hear people say, oh, there's more buyers in the market, or oh, there's more sellers in the market. It has to go down. That's false. The only way a transaction can get completed is if a buyer comes to a seller and they come into an agreement. You can never have two buyers looking to buy from one seller. It's impossible. There will always be a buyer and a seller for every transaction, and there will never be more buyers than sellers, or never be more sellers than buyers. Now you're probably asking, well, Carmine, if there's not more buyers than sellers, how can the market go up And how can it go down if there's always a buyer and a seller for every transaction? The only way the market can go up is if there's more aggressive buyers than passive sellers. And the only way the market could come down is if there's more aggressive sellers than passive buyers. For example, let's just say the market's trading at 4541, as you can see from the order book over here. Let's say we think the market's going to come up to 4545 for a quick little 4 points. Well, the only way the market can go up, if we were to look at the order book, there's a seller at 65 at 4541. The only way the market could come up right now is if there's more aggressive buyers, aka over 65 contracts, which hit the market at 4541, then price would uptick. Now we have an 89 looking seller. The only way the market could come up is if someone looks to aggressively buy over 89 contracts. Now, this is not to say that nobody else is going to look to pull or add on the order book. This is just saying if it's stagnant and no one removes an order and no one adds an order. If it's left at 65 and it's left at 89, someone would have to come in and we would have to see over 65, over 89, over 94, over 118, right? It doesn't have to be in this exact second. It could be over time. But the market is constantly fighting between buyers and sellers. But the only way the market could go up is if there's more aggressive market buy orders than passive sell orders. So if the market theoretically went up, we would have to see very aggressive market orders hitting the market. And if the market wanted to come down, we would have to see very aggressive market sell orders hitting the bid. In its simplistic terms, that is how the market moves. And there's way more in-depth strategies to organize this data, such as delta, such as a footprint chart, such as a reconstructed tape, such as a heat map. A lot of people, and I agree with them with this, the time and sales moves very fast, the level 2 moves very fast, but you have to train your eyes, and there's tools to simplify this data so you don't go crazy. So what you're going to see here is the S&P 500 have a very large sell-off into a demand zone where we broke a low a day, and we also broke a pre-market low. So this is a good recipe for a lot of traders looking to possibly get short into the market. So I pulled up a time and sales right here. I'm not even going to show you the level 2 because the time and sales is more important in this example. And also I forgot to mention that it's not very important to look at level 2 data or passive orders so much. Don't devote your full focus into looking at passive orders. For example, you might see a really large order appear at a random price at a random time, and you might say, okay, I want to watch this level. All passive orders do not show true intention, meaning I could go slap a 500 lot order looking to buy at 45 or 4490. And as soon as we come close to 4490, I can remove that order. Now, there's algos, it's spoofing, it's definitely illegal, but there's a lot of workarounds around that. But I see a lot of new traders putting a lot of focus on passive orders and seeing really large size in a level 2, and eventually they never get filled or they don't show intention. So the only real way that I'll look at an order on the level 2 is if it gets filled or if it shows intention. What I mean by that is if I see a really large bid there for, let's just say 500 contracts or 1,000 contracts, and as we come close to him, he disappears, well, that's not really something that I'm interested in looking at. However, if the market comes down into his bid at 500 contracts or 1,000 contracts, and we see the market aggressively sell into him, and the sellers are market ordering into the bid aggressively, and this guy with 1,000 contracts is slowly getting smaller. He was 1,000, now he's 800, now he's 300, now he's 100, then that's something that I'm going to pay attention to. However, because that shows intention. So you want to look at level 2 orders on the bid or the offer or the ask that show intention. That's very key. And because of that, I prefer and I put a lot of my focus on the time and sales and completed transactions because you cannot fake it. If someone just hit the bid for 1,000 contracts at 4507, then I need to use context to understand what's going on. It's a completed transaction. It has happened already. It's occurred. Order books don't show completed transactions. They just show levels that people possibly could be looking to buy or sell at. They don't show intention like a time and sales does. So what we're going to see in this example is you're going to see the market sell off aggressively, and you're going to see very large size hitting the bid inside of a demand zone. And you could also see that again from this volume candle. It's pretty much the highest of the day at this 1029 candle right down there. And that's going to coincide with very aggressive sellers hitting the bid aggressively, yet the market cannot move lower. This is a very good indication that the market may want to reverse higher. If there's tons of sellers hitting the market and the market cannot move any lower, well, that means there must be a passive buyer absorbing all those aggressive sellers. And that also brings me into another point I forgot to mention. It's also very possible there's many algos, there's many different in-depth advanced tools that firms or funds do have access to that we retail traders don't, to not really show our size, yet get filled a really large position. For example, there might be 1,000 contracts which hit the bid, but we don't see 1,000 contracts on the bid at that price. There's many loopholes, or there's many strategies or order execution routes to get away with it and get around it. That's why the time and sales will always be the most important tool. So in this example, you're going to see a ton of orders slamming the bid, aggressively selling into the bid, yet the market cannot move any lower. You could also validate that by that volume candle, and eventually the market reverses and we see a rally to the upside. This is how you can capitalize on a possible reversal setup by flipping the switch. All this aggressive selling, but no downside follow through. Well, there has to be a passive buyer absorbing all the selling, and the only way the market can move thereafter is up if those sellers get exhausted. And in this example, I'm going to replay it here on 2 times the speed. And you're going to see as we come down, I'm going to try to pause the replay here. You're going to see a large amount of size selling into the market. Okay, so we kind of see it right here. We see a very large aggressive buyer at 4508. 880 contracts as the market's moving lower. That's something that you really don't see often. As we're moving lower, someone hits the offer. You're also going to see 153, 116, 340. I could keep scrolling down and show you a bunch of other size, but what happens here is there's tons of selling activity. Look, 329, 340, and there's no downside follow through whatsoever. And eventually the market reverses. Tons of volume, the tape sped up. So a fast moving tape is a very good indication of this. That's why, again, the time of sales is very important. A fast moving tape means there's a lot of orders, there's a lot of transactions, and a lot of volume coming into the market. And this is how you would have been able to capitalize by spotting that size in real time on a very large reversal, especially that we're inside of a demand zone. And this is how you could use order flow. And 2 of the most important trading indicators that you have to understand in order to really understand how the market auctions and how it facilitates trade. So this is a lesson that I want you all to save. Go back when you need it, replay it 2 or 3 times to get it stuck in your head. If you enjoyed this video, I'd really appreciate a like on it, comment any questions, and definitely I would really appreciate it if you would subscribe to my channel and share this video with other traders. But besides that, peace.